The basics of financial responsibility. What does it mean to be financially responsible? It's a complex question with a complex answer, but at its core is a simple truth. To be financially responsible, you need to live within your means. And to live within your means, you must spend less than you make. Credit cards and debt. If you're really looking to be financially responsible, just being able to make your minimum monthly credit card payment doesn't cut it. In fact, the fact that you aren't able to pay your balance in full shows that you already spend more than you earn. Responsible use of credit means paying the balance on your account in full each month. Also, credit cards should be used for convenience, not to make ends meet. Credit cards are handy because they eliminate the need to carry cash. Plus, you can generate reward points. Credit cards can be very helpful in an emergency. That said, if an emergency does force you to carry a balance on your card, living in a financially responsible manner means curbing your spending until that balance is paid off. Consider the interest. The same logic applies to all recurring payments that involve paying interest. Think about it. Paying interest on anything means that you are spending more on that item than the purchase price. Does that sound like the most responsible choice, or just the most convenient? When the interest payments are factored into the purchase price, you are spending more to obtain the item than even the item's manufacturer thought it was worth. As such, avoiding paying interest on anything should be a major objective. Of course, when it comes to the cost of housing and personal transportation, avoiding interest is impossible for most of us. In such situations, minimizing the amount you spend in interest each month is the most responsible action, acting in your own best interest. For many people, cutting down on interest and borrowing is easier said than done. But in practice, it really comes down to knowing the difference between necessities and luxuries. For example, you might need a car, but you don't need a top-of-the-line model, and unless you can afford to pay for it in cash, you shouldn't be driving one. Likewise, you might need a place to live, but you don't need a mansion. And while most of us must have a mortgage in order to afford a home, purchasing a home in a financially responsible manner means that you should purchase one that won't break the bank. In financial terms, this means it shouldn't cost more than 2 or 2.5 times your yearly income. Another healthy estimate is that your monthly mortgage payment should not cost more than 30 of your monthly take-home pay. In addition to avoiding overspending on your home purchase, you should make a down payment that is large enough to eliminate the requirement of having to pay for private mortgage insurance, PMI. If you can't afford to meet these purchasing guidelines, rent until you can afford to buy. Paying yourself first. Saving. Spending every dime that you earn is simply irresponsible unless you have a massive trust fund that is so flush with cash that you will never outlive the earnings. For most people, especially those of us hoping to retire someday, saving is an activity that must be taken seriously. A great way to do this is when you get your paycheck. And before you pay your bills, pay yourself first. A good goal to save is 10. When it comes to saving, investing in the stock market might be the most profitable choice available. Sure, investing involves risk, but taking calculated risks is sometimes a necessity. The responsible way to go about it is to have a plan. Start by examining asset allocation strategies to learn how to choose the right mix of securities for your investing strategy. From there, contribute to your employer-sponsored savings plan if such a plan is available. Most employers offer to match your contributions up to a certain percentage. So, by contributing at least enough to get the match, you earn a guaranteed return on your investment. If your finances permit, maximize your tax-deferred savings opportunities by contributing the full amount that the plan allows. After you've started investing, monitor the progress that you're making toward your goals and rebalance your portfolio as necessary to remain on track. Emergency fund. Financial responsibility means being prepared for the unexpected. Most experts agree that you need to be able to support yourself financially for at least 6 months without an income. If you are married and used to living on dual paychecks, this means being able to pay the necessary bills such as the mortgage, food, and utilities on one income, or even neither income. If a missed paycheck would ruin you financially, it's time to create a financial escape hatch to prevent this. Don't keep up with the Joneses. Financial responsibly means doing what you have to do to take care of your needs and the needs of your family. To make this happen, your focus should be internal. The neighbors aren't paying your bills, so their spending habits shouldn't dictate yours or set the bar for your standard of living. Budgeting. Having a budget is one of the core pillars of financial responsibility. You should know where your money is going. Business owners know the importance of understanding their cash flows and balance sheets. As a result, no successful business exists without a budget. Neither should you. A very personal definition. Does being financially responsible mean that you have to scrimp and save? Maybe, but only if that is what it takes to stay out of debt. On the other hand, if you are the Sultan of Brunei, you may easily be able to afford a jet, a mega yacht, a mansion in the south of France, and a few palaces. Although those of us with lesser means might frown on this extravagance, it shouldn't be confused with a lack of financial responsibility. After all, there's nothing irresponsible about buying things you can afford to pay for. Arriving at responsible. Ultimately, financial responsibility means living within your means, regardless of the level of those means. So take a close look at your financial situation, evaluate your earning and spending habits, and make the necessary adjustments to put yourself on responsible financial footing. 7 ways to recession-proof your life. There are many everyday habits that the average person can implement to protect themselves from the sting of a recession, or even make it so that its effects aren't felt at all. As the recession hits, these tools can help you get through it in one piece financially. Key takeaways. Individuals can develop habits that will protect them ahead of time, even if an economic slowdown or recession takes hold. In terms of income, having an emergency fund, strong credit, multiple sources of income, and living within your means are all important. In terms of investments, individuals need to think long-term and diversify holdings, as well as be realistic about how much risk they can handle. Have an emergency fund. If you have plenty of cash lying around in a high-interest federal deposit insurance corp (FD) insured account, not only will your money retain its full value in times of market turmoil, but it also will be extremely liquid, giving you easy access to funds if you lose your job or are forced to take a pay cut. Also, if you have your own cash, you'll be less dependent on borrowing to cover unexpected costs or the loss of a job. Credit availability tends to dry up quickly when a recession hits. Once these things happen, use your emergency fund to cover necessary expenses, but keep your budget tight on discretionary spending in favor of making that emergency fund last and restoring it ASAP. Live within your means. If you make it a habit to live within your means each and every day during the good times, you are less likely to go into debt when gas or food prices go up and more likely to adjust your spending in other areas to compensate. Debt begets more debt when you can't pay it off right away. If you think gas prices are high, wait until you're paying a 29.99's annual percentage rate (ATRAR) on them by fueling up on a credit card. To take this principle to the next level, if you have a spouse and are a 2-income family, see how close you can get to living off of only one spouse's income. In good times, this tactic will allow you to save incredible amounts of money. How quickly could you pay off your mortgage? Or how much earlier could you retire if you had an extra $1,000 a year to save? In bad times, if one spouse gets laid off, you'll be okay because you'll already be used to living on one income. Adding to your savings will stop temporarily, but your day-to-day frugal spending lifestyle can continue as normal. Have additional income. Even if you have a great full-time job, it's not a bad idea to have a source of extra income on the side, whether it's some consulting work or selling collectibles on eBay. With job security so non-existent these days, more jobs mean more job security. Diversifying your streams of income is at least as important as diversifying your investments. Once a recession hits, if you lose one stream of income, at least you still have the other one. You may not be making as much money as you were before, but every little bit helps. You may even come out the other end of the recession with a growing new business as the economy turns up. Invest for the long term. So what if a drop in the market brings your investments down 15? If you don't sell, you won't lose anything. The market is cyclical, and in the long run, you'll have plenty of opportunities to sell high. In fact, if you buy when the market's down, you might thank yourself later. That being said, as you near retirement age, you should make sure that you have enough money in liquid, low-risk investments to retire on time and give the stock portion of your portfolio time to recover. Remember, you don't need all of your retirement money at age 66, just a portion of it. 1. It might be a bear market when you're 66, but it could be a bull market by the time you're 70. Be real about risk tolerance. Yes, investing gurus say that people in certain age brackets should have their portfolios allocated a certain way. But if you can't sleep at night when your investments are down 15 for the year, and the year isn't even over, then you may need to change your asset allocation. Investments are supposed to provide you with a sense of financial security, not a sense of panic. But wait, don't sell anything while the market is down, or you'll set those paper losses in stone. When market conditions improve is the time to trade in some of your stocks for bonds, or trade in some of your risky small cap stocks for less volatile blue chip stocks. If you have extra cash available and want to adjust your asset allocation while the market is down, you may even be able to profit from infusing money into temporarily low-priced stocks with long-term value. Buy low so that you can sell stocks high later, or hold on to them for the long run. Be careful not to overestimate your risk tolerance, as that will cause you to make poor investment decisions. Even if you're at an age where you're supposed to have 80s in stocks and 20s in bonds, you'll never see the returns that investment advisors intend if you sell when the market is down. These asset allocation suggestions are meant for people who can hang on for the ride. Diversify your investments. If you don't have all of your money in one place, your paper losses should be mitigated, making it less difficult emotionally to ride out the dips in the market. If you own a home and have a savings account, you already have a start. You have some money in real estate and some money in cash. In particular, try to build a portfolio of investment pairs that aren't strongly correlated, meaning that when one is up, the other is down, and vice versa, like stocks and bonds. This also means that you should consider asset classes and stocks in businesses that are unrelated to your primary occupation or income stream. Implementing these financial strategies will not only serve you well during a slowdown, they'll also serve you well no matter what's going on in the market. Keep your credit score high. When credit markets tighten, if anyone is going to get approved for a mortgage, a credit card, or another type of loan, it will be those with excellent credit. Things like paying your bills on time, keeping your oldest credit cards open, and keeping your ratio of debt to available credit low will help keep your credit score high. When times are tough, maintain communications with your creditors to keep them happy by making arrangements to keep your accounts in good standing. Many lenders and businesses would rather see you continue to be a customer than have to write off your account as bad debt. What is a recession? A recession means a significant decline in general economic activity. The macroeconomic term has traditionally been recognized as 2 consecutive quarters of decline, as reflected by gross domestic product, GDP, and other indicators such as unemployment. However, the National Bureau of Economic Research, NBER, currently defines a recession as a significant decline in economic activity lasting more than a few months, normally visible in real GDP, real income, employment, industrial production, and wholesale. 2. How can I prepare financially for a recession? There are many everyday habits that you can implement to protect yourself ahead of time from the sting of a potential economic downturn or recession. Having an emergency fund, strong credit, multiple sources of income, and living within your means are all important tools that can help you get through a rough patch in the economy in one piece financially. How can I make my investment portfolio more resistant to a recession? In terms of investments, being prepared for a recession involves taking a long-term approach to your investment goals, diversifying your holdings, and remaining realistic about your risk tolerance. The bottom line. The key to riding out a recession starts with planning ahead for the worst-case scenario. Build up your emergency fund, pay off your high-interest debt, do what you can to live within your means, diversify your investments, invest for the long term. Be honest with yourself about your risk tolerance and keep an eye on your credit scores Once a recession does hit, it's smart to look for a side gig to keep money coming in. The best protection against bad trouble is good planning. If you haven't done so already, now is a good time to emergency. Proof your finances. Doing so can help limit your overall disruption, lower your stress, and put you in a better position to ride out any emergency, whether it's a family crisis, a hurricane, or a global economic crisis. Key takeaways. You never know when an emergency will strike, so it's best to have a plan to get you through a crisis. Because of the normal bust and boom cycles of the economy, there will always be downturns. To prepare, save an emergency fund, make sure your insurance is adequate, create a budget, and pay down debt. Designate a financial and medical power of attorney and create a will. Boom and bust cycles. While it's difficult to predict when or if a recession will hit, downturns happen eventually because the economy goes through boom and bust cycles. When the Dow Jones Industrial Average, GJ, the Dow, fell 777.68 points, 6.98 in intraday trading on September 29, 2008. It was the largest point drop in history. Today, we can almost feel nostalgic, remembering the good old days when GJ losses were measured in hundreds instead of thousands. 1. In 2020, when the U.S. first realized the seriousness of the economic crisis and lockdown, and that a recession was likely unavoidable, the market sustained epic losses that make the 2008 financial crisis look like small potatoes. The stock market crash of 2020, as it's now called, started on March 9, when the Dow fell 2013.76 points, a 7.79 drop. On March 11, the Dow lost 1464.94 points to close 20.3 down from its FIBE 12 high, signaling a bear market and the end of the 11-year bull market that began in March 2009. On March 12, the Dow dropped another 2352.9. On March 12, the Dow dropped another 2352.9.9. On March 16, the Dow lost 2997.10 points, 12.93. Throughout 2020 and into 2021, the markets rebounded as optimism about vaccines and a global economic recovery took hold. But an event like the 2020 crisis shows that bear markets can arise, even amidst an otherwise healthy economy. 2. We never know when an emergency will strike, whether it's a hurricane, earthquake, or your own changing financial or medical situation. It pays to have a plan in place that can help get you and your loved ones through the crisis. It's never too late to work on emergency, proofing your finances. Financial health. It's easier to respond and adapt to an emergency when you're prepared. For starters, take a look at your financial health. Pay attention to your income, savings, investments, net worth, and debt. If you're like most people, you have room for improvement when it comes to your financial health. Here are a few things to work on. Make a budget and stick to it. People usually know how much money they have coming in, but it can be a shock to see where your money goes. Find ways to cut your costs if possible. Think, do I really need that? Do I have something already that I could use instead? Do I want this more than I want to be financially stable? Save and invest a certain percentage of your income every month. Put it in your budget to help make it happen and review your progress each year. Even though it's never too late to start, your money has more time to grow if you start early. And remember, economic downturns are temporary. Think long-term and do not panic. Be convinced that the best times to invest even more are these times. If you have extra money, invest it, and most importantly, do not sell your investments at those times. Organize your important documents so you know where to find them in an emergency. Consider putting your hard-to-replace documents, collectibles, and heirlooms in a safe deposit box. Since you can't access a safe deposit box 24/7, however, don't put anything in it that you might need in a hurry, such as a passport or the only copy of a living will, advanced medical directive, or durable power of attorney. Improve your credit score. During a recession, lenders favor the strongest borrowers. You will have access to better terms and rates if you have a higher credit score. Designate a financial power of attorney who can make financial decisions on your behalf if you're physically or mentally unable to handle your affairs. Emergency fund. Financial planners recommend that you should set aside 3 to 6 months' worth of living expenses in an emergency fund. If you're able to, it's a good idea to save even more. Keep in mind that your emergency fund should be used only in a true emergency, such as to make ends meet when you're unemployed, recovering from a natural disaster, or need to pay medical bills. Fast cash. If you don't have an emergency fund, or you've already burned through it, you might need to raise some cash as quickly as possible. Here are several options for doing so. Go through your home and garage to find things you can sell. Post your items on an online marketplace, such as Facebook, eBay, ThreadUp, OfferUp, LetGo, or hold a yard sale. Borrow from your retirement account. You may be able to take a short-term loan from your 401k and do your best to pay it back on time. The maximum amount you may borrow from your 401k plan is either 50% of your vested balance or $50,000, whichever is less. 3. Borrow from friends or family. This one is tricky because it can put a strain on relationships. Be careful what you promise and always follow through. Earn extra cash. Work extra hours at your existing job if it still exists. Ask for that long, awaited raise, or find a side hustle. With working from home on the rise, many job sites, such as flex jobs, advertise flexible hours, remote contracts, or part-time jobs. Websites like Upwork and Freelancer have abundant freelance gigs for many skills. So does TaskRabbit. Any funds you borrow from your 401k lose the benefit of tax-deferred growth on earnings. Debt management. It's a lot easier to face an emergency if you don't have a lot of debt. Good debt has the potential to increase your net worth, such as borrowing for college, a home, or a small business. Bad debt is when you borrow to buy something that doesn't increase in value or generate income, including cars, clothes, and most credit card debt. Whether you're facing an emergency or not, it's always a good idea to avoid bad debt as much as possible. Still, if you can't pay your bills due to an emergency, you may be able to take out a low-interest loan to consolidate higher-interest debt. Ask for debt settlement, in which a lender forgives part of your debt. Ask your lender about debt relief programs. Insurance coverage. Insurance is an essential part of emergency planning. Review your insurance, including property, health, life, car, and umbrella policies, to make sure you have the right amount of coverage and to make changes if necessary. Look at whether you should buy disability insurance to help replace earned income should you become too disabled to work. You may be able to save money on your premiums by taking advantage of any available discounts, such as for bundling your car and property insurance. It's a good idea to call your insurance provider once a year, for instance, when you get your renewal notice in the mail, to make sure you're not missing out on any deals. Healthcare. Making sure you have adequate health insurance is only one aspect of your overall healthcare. To prepare for emergencies, it's essential that you also have a medical power of attorney, a legal document that gives one person the power to act for or on behalf of someone else. Also important, anyone over age 18 must give written permission for someone else to receive medical information about them, even if the other adult is a parent. You'll need a medical power of attorney to make decisions on your adult child's behalf if they become incapacitated. So, in addition to making sure you have assigned that power to someone in case something happens to you, be sure both adult children and other adults in your family have these documents in place. Make a will, along with a medical and a financial power of attorney. Everyone needs a will, even if you're a long way from being old. A will is a legal document that sets forth your wishes. If you die without a will, your wishes may not be carried out, and when your estate goes into probate, a court will be in charge and additional fees will likely be imposed. A living will is a separate document and also important. It sets forth your wishes for medical care if you become incapacitated, including whether you want to be resuscitated or if life support should be used to prolong your life. When disaster strikes, any emergency is disruptive and difficult, even when you're prepared for it. But if you haven't planned, it can be even more challenging. Emergencies, whether natural disasters, illnesses, or recessions, are all but inevitable, so it makes sense to prepare for them as best as you can. That way, you may be able to lessen the disruption, reduce your stress, and be in a better position to ride out the crisis.